Hello everyone, this is Jennifer. So in this video we're going to talk about the lease and impairment accounting standards. So first we'll start up with the lease. So what is a lease? A lease is basically an agreement wherein the lessor gives the right to use an asset for an agreed period of time in return for a series of payment to the lessee. Okay, so it's an agreement between the lessor and the lessee. So it's an agreement between the lessor and the lessee wherein the lessor gives a right to use an asset for an agreed period of time to the lessee. So what is the scope of this particular standard? So lease agreements are related to the Ind AS 17. So it basically prescribes for the lessor and the lessee the appropriate accounting policies and the disclosures to apply in relation to leases. So talking about the scope, this standard shall be applied in accounting for all leases other than mineral, oil, natural gas and some non-regenerating resources, so which cannot be easily remade by the remade or replaced. Only it takes a lot of time by the natural means. So such assets will not come into the picture of lease agreements. And also licensing agreements for items as motion picture films, video recording plays, manuscripts, patents and copyrights. So the leasing agreements which happens, or the licensing agreements which happens between a party for copyrights and all such things also will not be considered under this particular standard, and which is not applicable at all. So this standard is not applicable at all to property held by lessee, that is accounted for investment property. So the properties held by lessee that is accounted for investment property will not come here, but it will come under the investment property accounting standard, and the investment property provided by the lessors under the operating lease, and the biological assets which come under the scope of Ind AS 41. So these will not come into the picture of the lease agreements, or this will not come into the picture under this particular standard. So talking about types of lease, so we saw what is something called as operating lease. So let's look on to what are the different types of leases. So leases are basically of two kinds, which is financial lease and operating lease. A financial lease is a lease that transfers substantially all the risk and rewards incidental to ownership of an asset. So only title may or may not be transferred immediately. Whereas operating lease is a lease other than the financial lease, or it can also be known as a lease wherein it does not transfer substantially all the risk and rewards incidental to ownership. The third kind of lease is a sale and lease back transaction. So what do you mean by sale and lease back transaction is wherein one sells an asset and leases it back after a long time or for a long time. So therefore one continues to use the asset but no longer owns the asset. So you sell the asset, again you take back the asset on lease transaction. So that is sale and lease back transactions. So when we are talking about how you're going to show these lease agreements or the leases in your financial statement, that is what is your standard dealing with. So when you look into that, there are basically two parties who are involved in lease agreement. One is the lessor and the other one is the lessee. So how we are basically going to show in the respective books of the lessor and in the respective books of the lessee, that's what we're going to see here. So in the books of the lessee, so the financial lease shall be recognized will be recognized at the fair value of the lease property, or if that is lower than the present value of the minimum lease payment. So meaning to tell, the lessee shows the financial lease, financial lease statements assets and liabilities in its balance sheet at amounts equal to the fair value of the lease property or at the present value of the minimum lease payments. And in operating lease, if it's operating lease, how does the lessee shows? So if it is an operating lease, the lease agreements will be recognized as an expense, and on a straight line basis, if it is on a straight line basis, the fee is paid over the lease term. Okay. And what about the lessor? So for in a financial lease, the lessor shall recognize assets held under financial lease in their balance sheet as a receivable at an amount equal to the net investment in the lease. And in the operating lease, the lessor shall basically account it as an income. Okay, shall be recognized as an income. And what about the sale and leaseback transactions? So if a sale and leaseback transaction results in a financial lease, any excess of sale proceeds over the carrying amount. So what do you mean by carrying amount? So carrying amount is the amount at which an asset is recognized after deducting your depreciation, your impairment losses, etc. So if it is a sale and leaseback transaction in a financial lease, the excess of sale proceeds over the carrying amount shall not be immediately recognized as income by the seller, that is the lessee. Instead, it shall be deferred and amortized over the lease term. And if it's an operating lease, it is very clear that the transaction is established at the fair value. If there are any profit or loss, it shall be recognized immediately. If the sale price is below fair value, any profit or loss shall be recognized immediately, except that if the loss is compensated by the future lease payments. Moving on to our next standard, which is impairment of assets. So impairment of asset is Ind AS 36. So what do you mean by impairment of asset, or what does an impaired asset mean? So an impaired asset is an asset that has a market value less than the value listed on the company's balance sheet. For example, you have a machinery in your company, and the machinery which the recoverable value of the machinery or the market price of the machinery is 1 lakh, but in the company's balance sheet you are showing it as 1,20,000. So this 20,000 is nothing but it is an impairment which is not there. Okay, so the market value is less than the company's balance sheet. When an asset is deemed to be impaired, it needs to be written down on the company's balance sheet to the current market price. So this accounting standard basically deals with impairment of assets. So Ind AS 36 prescribes a procedure that an entity applies to ensure that its assets are carried at no more than the recoverable value. So what is the scope of impairment? So the impairment assets does not include all these. First one is the inventories, because we have a separate standard for inventories, which is Ind AS 2. Then is the contract assets and revenue from contracts. Then is the deferred tax asset. So what do you mean by deferred tax asset? As I told you all earlier, if you pay extra amount more than the tax liability, so that is known as deferred tax asset. So it acts as an asset for the future years. Then is your employee benefit assets, so which comes under the next standard. Next is financial asset, which are under the scope of Ind AS 109, which is financial instruments. So all these are covered up under different accounting standards. So this impairment of assets will not consider all this. Then the investment property, then the biological assets, then the deferred acquisition cost and intangible assets arising from the contractual rights, insurer rights, etc. Then is your non-current assets. So how do you basically identify asset that may be impaired? So So when we are talking about impaired asset, you also consider sometimes the intangible asset. So how do you consider the intangible asset is, even if intangible asset has no indication of impairment, but still we will consider it. How is it? Where we will see whether intangible asset with an indefinite useful life or an intangible asset not yet available for use. So based on this it will be tested. So recognizing and measuring in impairment cost. So there's something called as recoverable amount and carrying amount, which we always get into picture. Carrying amount. So carrying amount is the amount at which an asset is recognized after deducting any accumulated depreciation and accumulated impairment losses. And recoverable amount is the amount of an asset or cash generating unit which is higher of its fair value less cost of disposal and its value in use. So basically, if the recoverable amount of an asset is less than its carrying amount, the carrying amount of the asset shall be reduced to its recoverable amount, and that reduction is nothing but impairable loss, which is always adjusted. So if there is an impairable loss, it shall be recognized immediately in the profit and loss account unless the asset is carried at revalued amount in accordance with other standards. Or if any impairment loss of a revalued asset shall be treated as a revaluation decrease in accordance with other standard, or an impairment loss on a non revalued asset is also recognized in the profit and loss account. So we have done basically different kinds of problems, so in that it gives a clear picture of how we consider the recoverable amount and the carrying amount, and how do we recognize the impairment cost. So moving on to our next standard, which is the income taxes, which comes under Ind AS 12. So it basically prescribes accounting for income taxes, which recognizes both the current taxes consequences of transaction and the events and the future tax consequences. So it basically talks about the future recovery or the settlement, then the transaction or other events of the current period which needs to be recognized, then the deferred tax assets arising, and the presentation of income tax and how basically you're going to disclose income tax in the financial statements, and also the disclosure of information to relating to the income tax. So what is the scope of the standard is applied in accounting for income taxes. For the purpose of the standard, income taxes include only all domestic and foreign taxes which are based on taxable profits, and the taxes such as withholding taxes which are payable by the subsidiary, associate or joint arrangement or distributions to the reporting entity. So it basically includes all kinds of taxes. Then recognition. So the current tax for the current and prior period, to the extent unpaid, will be recognized as a liability. If the amount already paid in respect of the current or prior periods exceeds the amount due to the periods, the excess will be recognized as an asset, which is a deferred tax asset. The benefits relating to a tax loss that can be carried back to the recover current tax of a previous period shall also be recognized as an asset. And when a tax loss is used to recover current tax of a previous period, an entity recognizes a benefit as an asset in the period in which the tax occurs, because it is probable that the benefit will flow to the entity and the benefit can be reliably measured. So talking about the measurement, current tax liabilities for the current and prior period shall be measured at the amounts expected to be paid to the tax authority. And what about the deferred tax assets and liability? It shall be measured at the tax rates that are expected to apply to the period when the asset is realized. Thank you, everyone.